up, beautiful people? This is Pope with Stock Doctor Trading. Now, we got a wonderful series coming up for you right now. This is going to go all week long. We're going to talk about the top 6 most commonly used trading strategies during a bear market. It's clear that we have recessionary pressures up ahead of us, at least for the rest of the year and well into 2023. I mean, when you combine interest rates rising, quantitative tightening, supply chain issues, negative GDP, a soon-to-be possible collapse of the real estate market, I think it's at least fair that we can admit right now, right? The 10-year bull run is over for now, right? Now, hold on. I don't want to say it's over in the long run for the bulls. It is definitely not. It's just we got to take that little idea of buying the dip, put that on the shelf for right now. We got to put it up there, unpack the bags, and look at some other ways that we can attack this market. Now, if in fact history is doomed to repeat itself, then we could expect this bear market to last maybe a year to 3 years long before we can actually see our next true bull run cycle. The question is now, what is a Hodl'r to do? The market's heading down for a long time. Do I just hold this stuff? The answer is no. Hodling is just a strategy for a short squeeze play. In a current downtrending market, we're not going to really have the juice to give them a proper squeeze play. So that particular concept is really for the end of bull runs, when there's still stimulus and liquidity in the markets. Squeeze plays are going to be tough to come by, at least long-term ones. I mean, we're going to see them like popping off here and there for a day, and then they'll come right back down. The bears are in control right now. And for us, there's no need to wait and hodl through a downtrending market. There are plenty of strategies and other ways to make market gains during a bear market. And that's what we're going to go over today. You see, everything about trading is all about adjusting your strategies at different time. If you want to play at the big boys table of the stock market, you're going to have to learn the big boy table strategies, especially during bear markets. Hey, and if you don't believe me, just check out Sun Tzu, in the Art of War. He was quoted as saying, and I'm paraphrasing, something like, strategy good, I think that's what he said. He said, strategy good. I'm not sure. I don't speak classic Chinese, so that book was written a long time ago. And because strategy good, that means we're going to cover the 6 most commonly used strategies in a bear market. I'm going to be rolling out a new video every day for the next 7 days, covering 6 of the top most common strategies used in a bear market. 6, why 7? Because on the 7th day, we're going to cover how a portfolio manager might perceive these strategies as a whole. And we're going to see how they might take on those strategies in a more diversified approach over a market like a bear market, where you have more volatility and less liquidity. And that's the point of why these strategies are akin to success in a bear market. So let's get to it. I don't want to waste any more of your time. The 6 trading strategies most commonly used in a bear market are: number 1, cash heavy. I call this the lurker, waiting around for that right time to strike. Number 2, that's fixed income. We're calling that le boomer. And that's just something that has to do with capital appreciation and maintaining the gains that you've already made over the years and not falling backwards or losing to inflation. Strategy number 3, grab your puts and your shorts and let's head to the beach. This is when you put the peaks and pops, AKA the Michael Burry. Number 4, short-term hedging, AKA that dirty hedging. This is a very, very commonly used strategy, but it's also very common to fail at it. This is one of the more technically advanced techniques for strategies, and we'll go over it in depth. Number 5, dollar cost averaging. Why don't you buy that dip, baby? Oh, let's get it. This one I'm calling the stalker, right? Because it's stalking around like Microsoft. What you gonna do, Microsoft? You going up, Microsoft, man? Because I'm right here, man. I'm gonna buy the dip, man. Man, just let me know, Microsoft. Is this the bottom? Is this the bottom? That's your dollars cost average by the dipper. Very common strategy these days. We're gonna go into it though. Number 6. All right, this is China stocks and emerging markets. So it's AKA the trader. These are the people that are willing to take their money out of the States and go check out some investments elsewhere. Your Charlie Mungers and your Ray Dalios are some of the most famous for that. And, those paper-handed traders. And those are the 6 we're going to be covering over the next 6 days. And don't forget, bonus day 7, where we're going to get an overarching umbrella view of how it's all going down. So hold on to your butts. We're about to get to it. Starting off, number 1, going cash heavy. Okay, if you're asking yourself right now if you are a lurker, then you have to understand that your beliefs are going to be something like, the best deal has yet to come. If you're saying that in your head, you might be a lurker. Also, if you're thinking history favors patience and tends to repeat itself, then you too might be a lurker. If you believe that because Warren Buffett is in cash, then you should be in cash, maybe you are a lurker. So being cash heavy to me is basically like you're saying in your trading portfolio that you're waiting for your pocket aces and that you're willing to wait for hit that level in order to get the move that you want, the bottom that you've calculated. So to me, I think being a lurker is a pretty good nickname for it, because basically you're just sitting there and you're waiting for your spot, picking your spot, like you might with pocket aces. Okay, now the pros of being cash heavy is that you're gonna be highly liquid and you can invest the moment that you're ready to see your opportunity and strike. That's the pro. You don't actually lose any money in the stock market while they're going down. You can actually just sit back, sip a Mai Tai and take a break from the market while it's trending down. And you can have that kind of stress-free, go at your own pace type of investing. I'm sure there's a lot of other pros, but these are the main pros. All right, the cons of strategy number 1, cash heavy. Number 1 is you will lose money to inflation, especially the inflation we have right now. So currently you would be losing roughly 8.1% on your cash for a year if you held it. So that is a con. That's what the problem is. Money as itself will lose value if you're not doing something with that money, if you're not making that money work for itself to grow. So that's a con of being a lurker. The second con is that you might actually miss the heavy price action levels that you're looking for. Like if you forget to set up price alerts, or if your levels are incorrect in any way and those price alerts go off, they show you no movement, and then all of a sudden one day later, you get the move that you were looking for and you're not paying attention because you're just easy breezing and lurking, you might actually miss your bottom. A lot of people say you can't time the markets. It's better to put time in the markets. We're gonna put that concept to test right now, because the idea is to not lose money. And long times in the markets means you're riding it down with the ups. This cash heavy strategy is meant to actually replace you from losing anything more than inflation and giving you an opportunity to strike. So make sure you set your price alerts, cash heavy lurkers. Now in each one of these 6, we're gonna cover some examples of what that portfolio strategy might look like. This one's really easy, all right? Pie chart, 100% cash. That's the holding. We'll get into more complicated ones when we get into the 3 and 4, and even 6 in terms of the strategies that have a much more complicated example of what your portfolio might look like. Being cash heavy, pretty straightforward. 100% cash. The lurker's way. All right, beautiful people, that is day 1 of our 7-day series on the top 6 most common strategies used in a bear market. We're gonna get down, get funky, and loose over this next week. We started off easy and smooth introduction, let y'all know what we're doing this week. Tomorrow we're getting into fixed income. We're gonna discuss exactly what a portfolio might look like, the pros and the cons, and then each day going forward until we get through all 6, you're gonna have a new, quick, easily digestible video that's coming at you fast. And over time, we're gonna start to extrapolate that in the future. This is so we can get all on the same page and start making some call outs together. But before we do, we have to understand what kind of strategies we're looking at, who we are, what we are. Today we covered the lurker, cash heavy portfolio. If that's you, give a shout out in the comments, let us know. You be holding, you be lurking, you be waiting for your moment. Let me know, let me know. See y'all tomorrow. Stock Doctor be out. Peace. All right.